Hello everyone, and welcome again to Nettle, the best platform around for distance learning in business, finance, economics, and much more. Please don't forget to subscribe to our channel and click that bell notification button below so that you never miss fresh videos and tutorials you might be interested in. Many thanks to our current Patreon supporters and YouTube members for making this video possible, and would also greatly appreciate if you consider supporting us as well, so please check the link in the description for more details. My name is Saba, and today we're revisiting algorithmic trading in Python using cointegration and the pair trading logic. However, today we're going to go slightly more advanced down the route and investigate the important concepts such as beta rotation or beta loading, stop losses, and optimal entry into our pair trading. And without further ado, let's just go through the code and run it on a test pair and see how well it performs and how you can tweak this code to your liking to facilitate your own algorithmic trading or research. So to start with, we are importing our 6 favorite packages for algorithmic trading in Python. Those are NumPy and Pandas to work with arrays and data frames respectively. It is also Yahoo Finance, which is the Y-Finance package that allows you to use Yahoo Finance API to download data straight into your Python. Then we need Stats Models API, and we import it as SM. This is a package that allows you to run regressions and many other statistical models. Then we also need scipy.optimize for the numerical optimization tool that is built into this package so that we can optimize the cointegration between the two stocks in our pair. And for result visualization to plot some nice charts, we need matplotlib pyplot, and we imported it as PLT for brevity. Let's now import the packages, click and run over here, and move through the bulk of our code. So here we will be simulating a pair trading strategy on a very famous pair of US stocks. Those are ExxonMobil and Chevron, both from the energy industry, both large oil companies. And we are going to simulate trading for 2 years, from end of September 2019 until end of September 2021. And we're covering some periods of very high market volatility, such as March 2020, and the current turbulent situation with regards to energy supply, gas prices, and so on and so forth. So we'll be able to stress test our strategies and see whether it still delivers high returns as we would expect a pair trading strategy to do over the course of 2 years. And as a simple twist, now we will be going through rolling windows of quite a bit lower length than in the previous tutorial, where we used 1 year rolling windows, 252 trading days, and we will be using a different stationarity test, not your usual Dickey-Fuller or augmented Dickey-Fuller, to determine whether a pair is really cointegrated, whether the combination of the two stock prices at the dynamic equilibrium does really converge. We're going to be using the KPSS test. A separate video on KPSS test is actually available on our channel, so if you're interested in the concept of KPSS test and how to do it in Excel, please check this video out. However, here we'll be using KPSS test in Python and be using the scipy.optimize package to achieve the best cointegration possible at a particular day for a particular pair of stocks. And here we need to specify what is the maximum KPSS statistic that we would still be considering a pair to be cointegrated with. And here we are behaving slightly conservatively, and we are choosing not the 99% critical value that would be 0.76, but rather we are taking the 95% critical value, being more picky, less reliant on a pair being cointegrated. We need more evidence to make sure it is truly stationary, the combination of these stock prices. And that's why we pick the maximum value of the KPSS statistic that we would still take, so lower than that is great, equal to 0.46 is alright. Higher than that, we're not interested in trading in this pair. It's not cointegrated enough. So that is the first parameter we will be inputting into our code, and you can vary it to make your strategy more conservative if you reduce this parameter further, or less conservative, more lenient if you increase this parameter. Then we need to specify which procedure, which algorithm for KPSS statistic optimization will we use. The unbiased algorithm, where we vary one parameter and setting the average prediction error to be 0, that's why it's called unbiased, or a non-unbiased algorithm where we can vary both parameters, both the intercept and slope, and that would lead to a forecast in our rolling window of 21 days to be biased. However, we could potentially achieve greater precision with it. However, that would also make the code less efficient. It will make the code run for longer. And we'll consider both options and see how we define the optimization functions in both cases. Then we need to specify whether we want to perform beta rotation or beta loading, that is, weighting the stocks in our pair in proportion to their reverse betas to achieve higher market neutrality. However, here a strategy with beta rotation will be more assumption sensitive, as you are relying on a proper and precise estimation of those stock return betas. However, some practitioners say that beta rotation is a crucial concept, is a crucial building block for a successful pair trading strategy. So we'll see whether this truly does make a difference, and we'll consider a strategy with and without beta rotation or beta loading. Then we need to specify some generic strategy parameters. First of all, that is our trading fee. We'll be able to look at our gross returns and our net returns for more robustness. Does the strategy perform well if we account for some small, generous level of trading fees? Here we start with a trading fee of 1 basis point. If you encounter higher trading fees, which is most likely if you're an individual trader, you can vary this parameter and see how the results change. Then we need to also code for optimal entry and some risk management characteristics of our strategy. Optimal entry is simply a parameter that would dictate when do we enter the pair, when do we consider profit opportunities, that is the discrepancy, the divergence of the dynamic equilibrium we have identified using KPSS test and cointegration, when we consider this divergence to be high enough for us to profit from it. And here the optimal entry parameter is 2%. So we only enter a pair if it's co-integrated and if it's 2% or more away from the dynamic equilibrium, meaning that from one trade we are expecting to gain at least 2%. And here again, you can make your strategy more restrictive or less restrictive by varying this parameter. The lower it is, the more often you will enter positions, and sometimes that could lead to more frequent trades, so higher fees, but also not missing up on even smaller profit opportunities. And if you increase it too much, it can be the case that your strategy would just not trade at all and tell you to sit in cash throughout the whole period, which is perhaps not entirely desirable. Also, for risk management purposes, we account for stop losses, and here we will just track the current return that we have obtained since we have last entered a position, and if it would be lower than our stop loss threshold, we would just abandon the pair. We would just close our trade and reconsider our options. And here I have selected a stop loss of -5%, which is again quite a reasonable value. You could be less risk averse and select a higher stop loss, like 10% for example, or you could even be more risk averse and reduce your stop loss in terms of the magnitude, so like 3% or even 2%. However, that would mean that you would abandon potentially profitable trades quite a bit more often. And in terms of optimal exit from our pair, we actually have this built in to the logic of pair trading, as by default we are exiting the pair and start reconsidering our options again when the dynamic equilibrium is restored. So we do not need to code optimal exit, such as a take profit order, for example. We only can exit a pair before it crosses back to the dynamic equilibrium only when our losses have been high and we might suspect that the equilibrium has broken down. Hence, stop loss is there, but take profit is kind of implicitly built into the strategy. Then we need to specify where we start. We initially start in a cash position, so we're not in position at the start of the simulation. So our initial signal is 0, meaning that we are in cash. A signal of 0 means you're in cash. Signal of 1 means that you long one stock and short the other. And -1 means the reverse, so you long the second stock and short the first. Then current return is a variable that allows us to do stop losses, which tracks our current return in position, so after we have entered our most current trade, most recent trade. And as we might perform beta rotation, signal is not enough to calculate our returns and our weights in those stocks. We will be weighting them in accordance to the betas of the other stock. And that would potentially mitigate market risk exposure to a greater extent than if you would just select weights to be equal to 1 and -1 respectively. So here those positions would reflect betas if we would have specified that beta loading is equal to 1 over here. Then I have already touched upon our sample. To do beta rotation and compare our performance with the market index, I have selected the S&P 500 benchmark. Here is the Yahoo Finance ticker for S&P 500. And then we just do some interface building. We initialize a bunch of arrays and data frames that would help us keep track of the results as we move throughout our sample period. And we need an array of gross returns, an array of net returns, and market returns to study how well the strategy performs. We also need to keep track of our signals, so when we're in position, when we're out of position, what exactly are we longing or shorting, and just to keep track of how well the pair is cointegrated, we also keep track of KPSS statistics throughout the sample. And now we're good to go. We can start downloading our data for the whole period, and here is the simple Yahoo Finance download command. And we also need to download price values for the index that we can later use to calculate returns, calculate betas, do beta loading or beta rotation. And then we move through a loop, through a cycle, throughout our sample period. So here t is a time parameter, and we start as soon as we can do our first trade, estimate our first KPSS statistic on a rolling window of 21. So that's why we start at day window, and we move throughout the period until the penultimate day. Why penultimate day, not the last day? Well, that's simply because we cannot know what the return is on the last day, as we don't know the next close. So the final day when we can know our return, as per the strategy, is the second to last day, so the penultimate day. That's why len raw data -1. Then we just do some brushing up to be able to compare our current position with our past positions, to calculate fees, and to assist the logic of the code to a greater extent. So our old signal is equal to previous signal, and so other positions. Then we are moving through our subsample, so we chop up our raw data frame to account for the 21-day rolling window we have specified. And then, as usual, we start running our cointegration test. And here it is a KPSS test, unlike in the past version of the code, where it was a Dickey-Fuller test. And we use this simple logic, this dynamic equilibrium relationship between two stock prices. It's a long-run relationship that we seek to find and then exploit in our statistical arbitrage strategy. So we assume that the price of stock 2 is equal to some constant, some intercept A, plus some slope B, times the price of stock 1. And we just run a naive Euler's regression to get starting values of our A and B parameters. That is, to get some grip on where these parameters can lie, what is their magnitude potentially, to enable faster convergence of our code so that we are not stuck, for example, in a local maximum, or that our code runs substantially longer. So that's a decent starting point from which we can converge to an optimal value using scipy.optimize. So we specify a linear regression with two stock price arrays as our dependent and independent variable respectively, and we add a constant to our independent variable so that we can also estimate A, our intercept parameter. Then we fit the regression and retrieve our A0 and B0, the starting values of the dynamic equilibrium relationship parameters, from the params of the estimated regression. And then we have to split our code into two, depending on whether we are looking for a unbiased or biased two-parameter optimization of the KPSS statistic. If we're looking for an unbiased optimization of the KPSS statistic, then we can only vary the parameter B, as if we fix parameter B, then the parameter A would be determined by default, so that the forecast in the 21 rolling window we have specified is unbiased. So basically that the average forecast for the equilibrium value of the second share price is equal to A plus B times the average value of the first share price. And that's exactly the logic that is enforced over here. If we have parameter B set, and we are varying it here in this function which we define in here, our parameter A is simply the average of the second share price minus B times the average of the first share price. And then we calculate our residuals, which are basically mispricings according to our estimated dynamic equilibrium relationship, and we calculate cumulative residuals using the NumPy cumulative sum function. And finally, we calculate the standard error for the KPSS statistic and calculate the KPSS statistic itself as per the usual formula. And we return this statistic so we can later minimize it using the scipy.optimize package and retrieve optimal parameter values. So here we use scipy.optimize minimize. We need the KPSS statistic to be as low as possible. The closer to zero, the closer to stationarity. So here we don't need to tweak anything. Minimization is what we are looking for. And we are minimizing the KPSS function with B naught as our starting parameter value. And we use nelda-meet as our optimization algorithm. If you want your code to be even more precise but slightly slower, you can use Powell as your method. However, here, when you've got a function of one parameter being B, nelda-meet performs very, very well, as this function is smooth and it's a very simple function of one parameter. And then our optimal value of the KPSS statistic is the function value from the optimization result, and that is how you retrieve it. And our optimal parameters, well, in terms of B, that's just the X value from the optimization result, and the optimal value of parameter A can be calculated as we want our forecast to be unbiased, meaning that the optimal value of A is the average between the difference of the second stock price and B optimal times the average value of the first stock price. However, if we want to optimize two parameters instead of one, so have a non-unbiased two-parameter KPSS optimization, we need to define a different function. And this function, KPSS2, is a function of an array of parameters, which I dub KPSS params. And A and B are basically the two elements of this array. That's how you would generally specify a function if you want to run it through scipy.optimize. And then we do exactly the same thing, specifying residuals, cumulative residuals, and calculating the KPSS statistic. However, here, the optimization code, the scipy.optimize minimize function, is slightly different. First of all, we need to make sure that we optimize the correct function, KPSS2. Our starting values is basically an array of A naught and B naught, and we still stick with nelda-meet. With two variable functions, it's also quite decent. Again, if you feel there is something fishy going on for your particular case, change that to Powell. Prepare for the code to be running slightly slower, but being more precise. And then we retrieve optimal parameters, again in a slightly different way. It's the same way for the optimal value of the KPSS statistic, just res.fun. And for the optimal values of A and B, those are now elements of the X array, the optimal independent variable array we have arrived at when optimizing our function. And now, having calculated either way, A and B, the optimal parameters that define the dynamic equilibrium for a particular trading day, we can start finally simulating trading. And what we need to do first is to check whether in the previous day, the decisions we made in the previous day led to a stop loss being triggered. And we can check that quite easily by just comparing our current return to the stop loss threshold. And if our current return is lower, so it's more negative than the stop loss threshold, then we need to stop trading. We need to exit the position immediately. So we set our signal to 0, meaning that we now sit in cash, so we liquidate our positions. And also, to just alert us that there has been a stop loss, we print a simple message that stop loss was triggered. Then, if we are not triggering a stop loss, if all goes smoothly, we need to check whether we are still in position, whether we have got a trade to finish, and we are waiting for the dynamic equilibrium to cross back, as we don't want to screw up a potentially profitable trade when the dynamic equilibrium is not yet restored. And here we can check it quite elegantly by comparing the sign of the difference between the current stock price and the dynamic equilibrium value with the old signal value. And if it's maintained, it means that we need to wait until the dynamic equilibrium is crossed back, so our signal is equal to old signal. And so we stay in position. We do not have to worry, we just have to wait until our position is closed profitably. However, if that's not the case, if we are not in position, or if our trade has been profitably closed already, we need to reconsider our options. First of all, we can only trade if the pair is co-integrated, so if our KPSS optimal value is higher than the maximum tolerable value that we have defined at the start, then we do not trade because this pair is not reliable enough. It's not co-integrated, so we cannot put our money, we cannot bet our money on it. However, if it is co-integrated, then we need to check whether we can enter this pair profitably. And that leads us to comparing the current divergence from the dynamic equilibrium in percent. So basically we divide the price by the dynamic equilibrium value calculated using optimal parameters and subtract 1. That would be the relative divergence from the dynamic equilibrium over here. So we compare it to the optimal entry parameter that we have specified previously as 2%. So if our profit opportunities are less than that, then we do not trade. We wait for more attractive profit opportunities. We don't want to trade too frequently, as that would lead to very high fees. And if profit opportunities are large enough, we can start trading, and the direction of our trade, so basically what we long or what we short, depends on the sign of the difference between the actual stock price and its dynamic equilibrium value, its fair value as per the pair trading. And then we need to also split our code in two to account for the fact that we might want to perform beta loading and we might not want to perform it. If we do want to do beta rotation, if we do want to adjust our weights according to stock betas, we first need to calculate the returns of our stocks as per the rolling window. So this code over here simply calculates the area of returns for our 21-day rolling window. And we need to also retrieve the market returns, the benchmark returns, which is S&P 500 in our case, in a similar fashion. And then we use OLS linear regression to calculate our beta, and we specify twice for two stocks and retrieve beta 0 and beta 1 for the first and the second stock respectively. And then we need to swap those betas around to make our position market neutral, so that we can then determine our positions from signals and the betas of the other stock in the pair. And having calculated those positions, we can already calculate the returns. And if we are not performing beta loading, then our strategy is even more straightforward. We simply assume those betas to be equal to 1 or to be equal, and our positions only depend on signals. So one stock goes there with a position of 1 and the other goes with a position of -1. And quite elegantly, if we are meant to stay in cash, this doesn't matter, as signal is 0 and positions are 0, which is exactly what we want. And now, having calculated the positions, either way, regarding our signal and our preferences towards beta rotation, we can calculate gross return using positions in two stocks and their respective returns in the next trading day. We're not looking into the future to make a prediction, we're looking into the future only to extract the returns that we would have made if we believed our forecast that we've made based on past data, obviously. And given gross return, we can calculate net return by subtracting fees from our gross return. And the amount of fees that we pay in percent is simply the level of fees, which is 1 basis point in our case, and we can adjust it upwards or downwards, not much downwards that you can go from 1 basis point, isn't it? But we need to multiply this level onto the sum of absolute changes in positions. That is basically the sum of absolute difference in terms of our position in stock 0 and stock 1, so first and the second stock. And that's exactly why we need this particular bit of code over here, so that we can compare our new positions to our old positions and calculate our fees in the correct way. And then we just calculate the market return this particular day, and then we can figure out what is going to happen with the stop loss in the next trading day. And here we just check whether we are still executing the same trade, so whether our new return counts towards the old current return for the purposes of stop loss calculations. If we are in the same position, then we simply update our current return to include the new return for the new day. And if we're in a new position, so our old trade is closed, or we have opened a new trade after sitting in cash, we update our current return to be simply equal to the new gross return. And then we populate our arrays that basically allows us to keep track of what is going on with variables of interest throughout the trading period. Then we build the output data frame, which simply condenses all of these arrays into one table. And then we visualize the results using PLT-plot, returning the equity curve for the gross returns of the portfolio, of the strategy, net returns of the strategy, and market returns. So we have something to compare it with. And finally, we can run the code, wait for a bit, and see how our pair trading strategy performed on the ExxonMobil and Chevron pair. Make sure that you have specified the parameters correctly as you want. So for example, here we have got an unbiased KPSS specification with no beta rotation, and we can see how it impacts performance. Then we can edit those parameters and see whether some of those tweaks to the code, some of these advancements we have implemented are actually beneficial in terms of performance. And we can see that 3 stop losses have been triggered throughout the trading period, and it won't be long until the code completes the calculations. And the code has just completed the calculations and plotted the performance of our strategies alongside with the market in a graph over here. We have got the gross strategy equity curve in blue, net equity curve in orange, so that is accounting for the fees, and the market equity curve is over here in green. And we can see that we have outperformed the market, particularly in the turbulent period around March-April 2020. However, the performance have been slightly flat since, meaning that pair trading strategies are quite dependent on market volatility and what's going on in terms of dynamic equilibrium and profit opportunities that arise from there. However, we still reliably beat the market with this strategy. However, we haven't even accounted for beta rotation. So let's see what's going on if we change this beta loading parameter from 0, which means don't do beta loading, to 1, which means do beta loading. And we run the code again, and let's see how it compares to our past result. And again, the code should converge in no longer than roughly a minute. And the code has just finished calculating, and we see here that a strategy with beta rotation does have quite a bit more upside. If you remember, the peak of the equity curve for the non-beta rotating strategy was around 1.7. Here we reach more than 200% of the initial portfolio value. However, the downside of the strategy is also higher, as overall we are not outperforming the market by that much as we did previously. And the final tweak I want to make to the strategy is whether a non-unbiased calculation of the KPSS parameter and the optimal parameters for the dynamic equilibrium, so A and B, impact the results positively or negatively. So let's run the code with this addition and see what's going on. And the code has just completed the calculations. We can see that doing a non-unbiased 2-parameter KPSS optimization actually harms our strategy results, as perhaps our A and B parameter estimation has become more noisy due to it being biased, and therefore we are not entering and exiting the trades when we were supposed to. So in that case, for Exxon and Chevron, we have verified that we have to stick with the unbiased KPSS optimization, and we might pick either a strategy with beta loading or without beta loading, depending on our risk tolerance. And please do consider tweaking this code for your own liking, considering different sample periods, different stock pairs, even testing it on different exchanges, and share your results. Have you been successful with the strategy? You might have delivered spectacularly higher returns than my current simulation. And that's all there is for advanced pair trading using KPSS cointegration, biased and unbiased KPSS parameter optimization, and most importantly, optimal entry, beta loading, and stop losses. Please leave a like on this video if you found it helpful. In the comments below, I'm eager to see any further suggestions for videos in business, finance, or economics you would like me to record. And please don't forget to subscribe to our channel or consider supporting us on Patreon. Thank you very much, and stay tuned.